Renting in Australia is an absolute mess.
New number crunching on Sydney's rental market shows those on welfare or the minimum wage can now afford just 1 in every 300 homes available for lease.
Well, more financial pain for renters is coming, with rental prices tipped to keep soaring for the next 2 years.
And with sky-high prices, poorly maintained housing, and a hyper-competitive market, the dream of home ownership also feels impossible for many.
Too many people, not enough homes, creating misery and a sense of hopelessness.
So, what's the solution? Running my own mortgage brokering business for over 10 years and a property investor myself, this is one of the most common questions I get asked, especially after explaining exactly what caused the housing crisis in the first place. Well, in my opinion, if you're ambitious, disciplined, and hardworking, and would still like to buy your first home or investment property, there are solutions even in this challenging market. And in this video, I'm going to share what's caused the rental crisis, why it's so bad right now, and the exact strategies I've seen hundreds of first home buyers use to successfully make the leap from renting to home ownership. Let's start with some context first. What's caused the rental crisis and how bad is it? To understand the really big picture, last year I covered the 8 drivers underlying Australia's housing affordability crisis, which explains why property prices are so high in the first place. However, 1 year on, despite 13 interest rate rises and the end of the fixed rate cliff, which I've also covered in another video, things haven't gotten much better, but have actually gotten worse. Property prices across Australia rose 7.6% over the last 12 months to August, with the median capital city house price now hitting 1.15 million and approaching 650,000 for units. And a multi-speed market is emerging, with home prices, especially in Brisbane, Perth, and Adelaide, each surging more than 15%. As for the causes of the current rental crisis, I've narrowed it down to 4 things. The first starts at the top end of the market. When house prices are unaffordable, households are priced out of home buying and simply need to rent for longer. Between the 2006 and 2021 census, the percentage of Australian households renting grew from 22% to 24%, totaling more than 2.9 million households. Importantly, 43% of renters have been renting for more than a decade or more. However, conditions are even worse at the bottom end of the rental market, with decades of underinvestment in social housing being the second cause. In New South Wales alone, there is currently an estimated shortfall of 200,000 social and affordable homes, with almost 60,000 households waiting for social housing. This means lower income households that should be in social housing are forced to rent, with stories of tenants skipping meals, selling their belongings, or living in substandard conditions to afford the rent. The third driver is immigration. After experiencing 85,000 net outflow of migrants in 2020 to 21, migration rebounded dramatically, with 204,000 net new migrants in 2021 to 22, and 518,000 net migrants in 2022 to 23. When new migrants arrive in Australia, they inevitably rent rather than buy a home. Finally, rental prices have been impacted by changing household size, especially after COVID. The desire for more space during the pandemic and the shift to working from home has shrunk the average number of people per household from 2.8 people in the 1980s to 2.5 people today. While this does not seem like much, the RBA estimates that if the average household size rose back to 2.8, we would need 1.2 million fewer dwellings to house our current population, an amount not to be sneezed at given it exactly equals the size of National Cabinet's Housing Accord target. So, in summary, there's a squeeze coming from the top end of the market as well as the bottom end of the market, while more and more people pile in and those who can afford more space price others out. The collection of these factors has unfortunately meant some of the worst conditions for renters in Australia's recent history. Since 2019, The median rent in Australia has grown a massive 40%, far outpacing growth in median incomes, which only grew by 19%. And according to Domain, over the last 12 months alone, rents for houses have gone up 11.1% across all capital cities and 8.6% for units. Of course, a key driver is ultra-low vacancy rates, which reached a record low of 0.7% as a national average in February this year, showing just how tight the rental market is. This has in turn led to the worst rental affordability in 17 years. Research by PropTrack indicates that the median income household earning $111,000 per year could only afford 39% of rentals listed on the market, assuming that they could only spend 25% or less of their annual pre-tax income on rent. And of course, this is disastrous for lower income households. For households in the lowest 20% of incomes, equivalent to $49,000 per annum, no rentals advertised in 2023 to 24 would have been affordable using this 25% definition. At the 30th income percentile, earning $67,000, only 3% of rentals advertised were deemed affordable. These findings are further supported by analysis by CoreLogic and ANZ, which found that in March 2024, the median income household had to use 32.2% of their income to afford the median rent of $621 per week, a record high in their research. The rental crisis is also bad for several non-financial reasons. Not only is it expensive to rent in Australia, but the tenant experience is also terrible. The main reason for this is tenure insecurity. In other words, not knowing next month if you will have the same roof over your head. It's estimated that 21% of tenant moves are involuntary, and up to 36.5% of private renters moved 3 or more times in the last 5 years, compared to only 6.4% for owners. And less than a quarter of private renters have a lease term of more than 12 months. The degree of tenure insecurity has forced the need for government intervention. For example, in New South Wales, the Minns government is implementing no-fault evictions from 2025, where landlords won't be able to evict tenants without a reasonable excuse, bringing New South Wales into line with other states such as ACT, South Australia, and Victoria. Secondly, the quality of rental accommodation in Australia is also a real concern and substandard when compared to owner-occupied homes. While this is to be expected, because a property investor is incentivized to spend the least amount possible for the maximum return they can get, that's capitalism for you, many homes are in need of significant investment in terms of upgrades and repairs, management of mold, and improving energy efficiency for heating and cooling. For example, Australian houses are notorious for being unbearably hot in the summer and absolutely freezing in the winter.
Brisbane renter Sam's fan followed him everywhere in his house during summer. The 25-year-old is one of 109 renters across Australia who tracked their home's temperature over summer for research. Results show it often got above the World Health Organisation's recommended range of 18 to 24 degrees.
The World Health Organisation puts the healthy zone for indoor temperatures at between 18 and 24 degrees Celsius. This research suggests most Australian homes are colder than that, averaging about 16.5 degrees.
All in all, this leads to a higher incidence of mental issues amongst renters, with 38% reporting their housing circumstances have a negative effect on their mental health. Not only is there financial pressure, but people get pushed away from the communities they have established, as well as put their health and safety at risk living in poor quality accommodation. So now we know how bad renting is. What can you do about it? This second half of the video is for those on the cusp of home ownership and want to make the final leap, or those who may be a little further off but want to know what it takes to buy a home and are serious about making a plan towards it. And while buying a home isn't for everyone, successful goal setting starts with a reality check of what you think is and isn't achievable given your unique circumstances. Let's start by understanding the rules of the game. Since mortgages were invented, the criteria to get a bank to approve your loan hasn't really changed. You're going to need a sufficient deposit and sufficient income. So in June 2024, the median house price in Australia was just shy of $800,000. This means that for the smoothest mortgage application, you will need $160,000 to cover a standard 20% deposit plus stamp duty and costs if they apply to you, and $134,000 or more in household income on today's interest rates to service the remaining $640,000 mortgage. Now, if these numbers seem overwhelming to you, don't lose hope. I'm going to let you in on a little secret. Most people think that having a large deposit is the key to buying their first home. And having been a mortgage broker for the last 11 years, in my experience, while a healthy deposit helps, it is not the key ingredient to first home buying and unlocking bank financing. Because the property market is so resilient and because banks make money lending to you, it is more important to focus on increasing your income and demonstrating you can comfortably afford a loan than it is to have a full 20% deposit. I have actually helped hundreds of first-time buyers with dozens of strategies to help them get into the property market. However, I'm going to go through the top 7 that I see my clients succeed with. Let's start with a fan favorite, rent vesting, the first strategy. It's definitely a buzzword right now, but if you're not exactly sure what it means, in basic terms, it's where you rent where you want to live and use your spare income to buy an investment property you can afford, ideally one that is high growth. The goal of rent vesting is that the investment property goes up in value, allowing you to sell it later to buy your first home. Alternatively, if your income allows, you can refinance the property and release the equity, again to buy your first home or to keep building your investment portfolio. In my experience with my client base, rent vesting does work. I've seen many clients succeed with rent vesting, but I've also seen other clients fail. There have been 4 key ingredients to all the winners. The first is high rental arbitrage. If possible, you need to pay a low rent where you live and earn a high rent where you buy. The most extreme of this is buying an investment property while you are still living at home or in a house share arrangement. The second is property selection. It's crucial to purchase a property in a high growth area for rent vesting to work. For example, in hindsight, our clients who purchased detached homes did better on average than those who bought apartments. The third is growing personal income. Rent vesting is not a static strategy, but a dynamic one. You still need to work on increasing your income if you desire a more aspirational first home or want to keep investing. The fourth is long-term commitment. Successful rent investors have been disciplined to hold their properties over multiple economic cycles to realize the full potential of their investment. The second solution I want to touch on is income boosters. At the time of this video, unemployment in Australia sits around 4.2%, well below the long-run average of 6.6%. If you follow the business news, you'll hear phrases like the labour market is tight and there's excess demand in the economy.
Melbourne small businesses are struggling to find staff as official employment figures reach levels hardly seen in the last 50 years.
What this means is there aren't enough workers to do the work out there. So how can you take advantage of this to boost your income? In the short term, can you work more hours, request more shifts, or earn overtime pay? Perhaps you can even take on a second job or work on a side hustle. In the medium term, can you earn a promotion, request a pay rise, or switch to a higher paying job? In the long term, can you complete higher education, work on a series of challenging projects, or retool and reskill to totally change your income trajectory? However, cycles change and unemployment won't stay this low forever and is expected to worsen as the economy slows.
The unemployment rate, which was expected to be on hold pretty much at 4.1% through July, is actually tweaked up to 4.2%.
This leads to my two biggest tips. Number one, invest in your learning to increase your earning. Our clients who comfortably buy their first home are not those who got an inheritance or financial leg up from their parents, but those who worked on themselves in becoming more valuable in the marketplace. Of course, you get the typical examples like the lawyer who got admitted, the doctor who became a fellow, or the accountant who became chartered. But I'm also talking about tradies who completed their apprenticeships, personal trainers who mastered social media, and software developers who taught themselves how to code. And my second tip, can you introduce performance-based pay into your work? Our highest paid clients are not on fixed salaries, but those with a strong component of their pay tied to their performance. These are salespeople on commission, professionals or department heads with bonuses tied to profits, or self-employed clients who only earn an income if they successfully sell a good or service. Ultimately, if you back yourself in your job, you should request that more of your income be driven by your performance. If you've already maxed out your current earnings potential or can't wait, there may be a quick way to boost your borrowing capacity that works, but it may not be available to everyone. That's to add a co-borrower to your application, such as a family member, partner, or spouse. The advantages of this approach are you get an immediate boost to your borrowing capacity, assuming you have a strong co-borrower. You get to own the property sooner and capture more growth or avoid being priced out later. You can share the load of the repayments, meaning your personal cash flow is better. However, there are also some disadvantages. You have to find the right co-borrower in the first place, someone you trust in the right financial shape and who will be in it with you for the long haul. A co-borrower may even disadvantage your application. For example, if they are on a lower income, have high living expenses, or existing loan commitments. The joint mortgage can affect your next loan application and reduce your overall borrowing capacity. This is because mortgages are jointly and severally liable, and standard practice by banks is that the whole mortgage is factored in your next loan application, even if in reality you are only paying half of the property's costs. It's for this reason that the best co-borrower is usually your spouse or partner rather than a sibling or parent. My personal tip for making this work is if you're already married or in a spousal relationship and want to buy a home, see if you can get the loan before you start planning a family. This is because your borrowing capacity reduces once you have kids. Often, the return to work income of one partner is reduced and the cost of a dependent is factored into your borrowing capacity. Now, I know buying a home before you have kids is not possible for everyone and must be done responsibly, but it is ideal for maximizing your borrowing capacity. So, we've talked about income. Let's now move on to deposits. We already established that buying a property takes a large chunk of savings. Earlier this year, Domain found that the average time for an Australian couple aged 25 to 34 to save the 20% deposit required for an entry-priced house is now 4 years and 9 months and 3 years and 5 months for an entry-priced unit. I'll add though that this is for an entry-level property. If average prices are used, this balloons to as many as 16 years to save for a house and 12 years to save for a unit. This is a huge amount of time and defeats the purpose of buying a home in the first place, which is to enjoy it. So, what solutions are there? The fact that demand and supply for housing are so out of whack is a form of market failure. Federal and state governments have tried to correct this failure by offering first home buyers grants, subsidies, and guarantees, the fourth solution on my list. However, the support is not designed to help all first home buyers, but those that need it the most. So it's important to check eligibility criteria in your particular state. Government assistance typically takes on 3 forms. First home buyers grants offered by each state with amounts of $10,000 in New South Wales and Victoria to even $30,000 in Queensland for newly built or substantially renovated homes. Stamp duty waivers and concessions, which are subsidies again offered by the state that apply to new and existing homes up to $1 million in New South Wales and $800,000 in Queensland. And the federal government's First Home Guarantee Scheme, underpinned by Housing Australia, where you can buy a home with a minimum 5% deposit and the Commonwealth Government will guarantee the remaining 15%, so you don't need to pay lender's mortgage insurance. That's if you earn a maximum taxable income of $125,000 as an individual or $200,000 as a couple. I'm now going to talk about the fifth solution, which is a highly controversial way deposits are funded in Australia. And that's the bank of mum and dad. This is where parents give their adult child a leg up into the property market by providing a gift or a friendly loan to support the deposit. Yes, it stinks of unfairness and inequality, but this is how many people get into the property market. Did you know estimates of total loans by the Bank of Mum and Dad vary between $35 and $92 billion, ranking parents between the nation's 5th and 9th largest lenders. And yes, personally, I do see this a lot. As a broker, I've seen all sorts of gifts from $10,000 to get someone over the line to huge 7-figure gifts. In fact, Finder found that the average gift in Australia is around $33,000. Now, whether this is reasonable or not is up to you and your parents, but if it helps you get into the property market sooner, are you too proud to take it? In making that decision, keep in mind that most parents are very happy to help their children get into the property market. They have worked hard all their lives, and it's one of the tangible ways of enjoying their wealth. It helps them to be near their grandkids, ensures support in their old age, and helps prevent their own children from being priced out of an ever-rising market. I truly apologize if this is not you. I'm simply calling it like it is, that the Bank of Mum and Dad is a force to be reckoned with in the Australian property market. But let's say you don't feel comfortable with receiving a gift from your parents. Maybe it's against your principles, or your parents don't have the funds in the first place. A family guarantee offers the sixth solution, where parents can help their children with lowering the required deposit without giving direct cash. How does this work? Under family guarantee, a parent's property is added to the overall security of a loan to bring the bank's loan-to-value ratio, or LVR, below 80%. This makes it safer for the bank to approve the loan, and it prevents the bank from needing to charge lenders mortgage insurance. The cost of LMI escalates the higher the LVR, so it's an expensive but very common tool first-time property buyers and investors use to get into the market. Going back to how family guarantees work, the borrower is then responsible for repaying the whole loan, and if something goes wrong, the guarantors are only responsible for paying back the portion of the loan above 80% LVR. The beauty of a family guarantee is that, in theory, a borrower can fund 100% of the purchase price plus costs, so it really works for clients with a high income but a smaller deposit. I must mention though, not every bank offers family guarantees, and eligibility can depend on your parents' income levels or work status, as well as whether there is sufficient equity in the guarantor property. If you're interested in a family guarantee, it's definitely worth talking to an experienced broker to see if you qualify. Now, let's move on to my last solution, or tip, if you will. A mentor once asked me, what's the quickest way to become wealthy? The answer: change your perspective. Think about this one. Many people don't feel wealthy because they are fixated on the things they can't control, not what they can. And this applies to the property market. If the average house in your desired suburb is unaffordable, or the numbers simply aren't working for you, maybe a shift in perspective is needed to unlock that winning purchase. There are affordability hacks all around. You just have to look for them. Can you change your location by living further out and considering the next suburb, taking advantage of remote work, or living outside of a capital city? Can you change your property type? Instead of a house, would you consider a townhouse or apartment to get a foot in the door in the suburb you want? Can you change your timing? Instead of buying now, can you wait until that next promotion or bonus? Can you change your living costs by rent vesting or cutting back your expenses to fast track that deposit? At the most extreme of these, I've seen many friends and clients change city, choosing to move out of Sydney and move regionally or interstate to benefit from more affordable property without compromising their incomes or quality of life. Opportunities are everywhere if you are open to them. So, that brings us to the end of the top 7 strategies that I see successful first-time homebuyers use when getting into the market, especially those making the jump from renting to owning. And believe it or not, this is just scratching the surface because there are dozens of banks, boundless opportunities in each state, and every client is unique. And if you're interested in seeing how we can potentially help you find some of these opportunities, I've left our contact form in the description box below. My final tip is that if buying a home is important to you, take every advantage that you can and don't hold back. Because life is not a fairness contest, but one where only the fittest and most committed survive. Keep working on yourself, keep an open mind, and don't give up on that property dream.